evening. This episode of the Intraday Price Action Recap is being brought to you by the Smart Money Manuscript. Hello, my name is Timothy Leroy Sr. and I'm the creator of the Smart Money Manuscript. But Tim, what is the Smart Money Manuscript? The Smart Money Manuscript is your roadmap to financial freedom. Inside this powerful course designed to transform your financial future, I've meticulously condensed over 1,000 of my public YouTube videos into 40 highly efficient lessons that span just 2.5 hours. This course is strategically designed into 4 phases to help guide your learning in the most logical and effective way possible. Phase 1 lays the groundwork, covering essential financial literacy like budgeting, banking, and taxes. In phase 2, you'll move beyond the basics, learning about brokerage accounts, figuring out how much you need for your own individual retirement. You learn about how to do fundamental research on companies, and you'll also learn how to conduct technical analysis by looking at stock charts. Phase 3 empowers you to build a robust portfolio and leverage your capital using advanced techniques like options and futures, and it also teaches you the importance of backtesting your strategies. Finally, phase 4 takes a deep dive into the advanced ICT concepts, giving you a professional edge. Each lesson includes a short quiz to help solidify your understanding. By the end of this journey, you'll have the confidence and tool that you need to make intelligent investing decisions, manage your money without fear or ambiguity. So if you want to be a long-term buy and hold investor, if you want to be a swing trader, if you want to be a day trader, if you want to trade stocks, if you want to trade options, if you want to trade futures, the Smart Money Manuscript is for you for $69.99. Yes, $69.99 for all of this here. Good evening, everybody.
Tim, lend me $2.
Man, I'm struggling out here, man. I'm trying to bounce back from Christmas, man. Man, it's bounce back season, boy. When I tell you, boy, look at him. I got a wife that said she had a good time. Well, she said she had a good. She said she enjoyed shopping for Christmas this year. Woo! What I tell you, boy. I still wake up. I still wake up in the middle of the night, like just from getting all of the all the receipts popping in. Emails, texts, notifications, phone going off. Now when my phone vibrate right now, I get scared. It's another one. Packages dropping at the door. Woo! Man, they say 'tis the season to be jolly. You already made that backstop tripping, man. I wish, man. And then all I got was a sweatshirt. Why daddy always just get a sweat? Daddy get a sweatshirt, a tie, some socks, right? I done got past the tie.
You've been crying. You got something white on your face under your left eye.
Dry skin. That's probably dry skin. Yeah, I am crying. About some, but it's dry. You know, I got dry skin. I got real dry skin on my face. I'll be trying to keep so around here. Yeah.
Yeah.
Dry skin. I get that bad skin from my mama. Let me see if I can.
He'll get you some Vaseline.
See if I can put some lotion, put some Jergens on there. Watch the Jergens don't even help. This real life right here, y'all. This real life right here. This is trading. You feel me?
You would have been like, why y'all didn't tell me?
Mm.
Okay.
Is that better? Do I still got the dry
That's
skin on my
better.
face? That's better.
That's better. Yeah.
I can still see it though. I got real bad skin. That's all right. The military paid me for it. The military paid me for it. That's part of my disability. I need to do like my wife and go back and get an increase. I ain't never go back and get an increase. She went back and got an increase on hers. I ain't never go back and get an increase because I don't be feel like dealing with them people, man. My wife always had really good experience with dealing with her VA claims. I know y'all ain't tapped in for this. When I first put in for my VA disability, because when I first got I was like, ain't nothing wrong with me. I don't need nothing. It's other veterans that they really need stuff. And then as I started getting a little older, this back when I was young too, as I started getting a little older, like, I started feeling the creaks and the cracks and the aches in my bones. So I put together got all my medical records. When I got out, this old head told me he'll like make a copy of all your medical records. You know what I'm saying? Because it's gonna be hard trying to track them down once you get out. Right. So I made a copy of all my medical records. And then I filed a claim. I put everything in there that I ever went to sick call for while I was in the army. And I filed my claim. Man, when I tell you it took me over 2.5 years and multiple calls. I started out calling once a month. Then it got so bad after like 18 months, I started calling once a week, right? It took me over 2.5 years for my claim to be finalized. And I got my award letter. And then when I got my award letter, they didn't put my dependents on there, like my spouse and my kids. So then I had to go through another 6 months of waiting for that to happen, right? The good thing about it is they pay you from the date you file, right? So when my first check was like a big check for like back pay, and then my second check was like another, it wasn't as big as the first one, but it was a larger check for back pay for my dependents. And so over 2.5 years. My wife, when she filed, 3 weeks later, everything was done. She got her award letter in 3 weeks. I said, you got to be freaking kidding me. 2.5 years, calling once a month for 18 months straight, and then once a week for the next 8-9 months. And she got it done in 3 weeks. I said, you got to be lying to me. You got to be lying to me. And then she went back this year and went back to get like an increase because she's still having like her issues are like increased. What, I don't know how you say it, like they getting worse, I guess. You know what I'm saying? Getting like what she filed, either what she filed is getting worse or something that she didn't file for was getting worse. But anyway, went back and then like less than a month later, got a back pay check, and the increased money was, oh my God, in totality from her beginning 3 weeks, then her increase less than a month. But me, that's why I was like, I ain't going down there. And plus, like everything that I filed for, it's like I got an award for it, except for like, I think one thing I got denied, they said is not service connected. Now, mind you, this is the main thing that I went for, and it's because of the military. But because it's a bilateral thing, I think they denied because whenever it's a bilateral thing, they have to give you like a little bump in the percentage. You know what I'm saying? Because it's bot meaning like your legs and your arms, right? And so they denied me on that, saying it's not service connected. And then something else, I think they rated me at 0. So anything they rate you at 0, you can always go back and get an increase on. But if they deny saying it's not service connected, then you can't get it saying that it's service connected. But God is good. I'm happy with the percentage that I got. So I ain't trying to be greedy and go back and work the system. Everybody I know be like, oh, you need to go get it. You know, my homeboy, oh my God, he is Mr. VA claim king. He even had got a job for many years at the VA clinic in Florida. He man, you need to go you need to get your 100%. You need to get your 100%. You need to get 100%. Everybody I know, they mean you need to get your 100%. You need to get your 100%. I be like, man, I ain't greedy, man. I'm thankful. I'm thankful for the hip. I don't need the whole plate. Hey, man, that ain't why y'all tapped in, man. Y'all tapped in to hear me talk about price action. You feel me? Good evening, good evening, good evening, good evening, good evening, everybody. If this is your first time tuning in to Tim's Tidbits, please allow me to say welcome. If it's not your first time tuning in to Tim's Tidbits, I still want to say welcome. But I want to give you a nice hearty. Well, thank you for always tuning in to Tim's Tidbits. If you don't know who I am, my name is Timothy Lee Rogers Sr., a.k.a. Aranya Grande. That's his big spider if you don't hablo Espanol. And you know I tuned to another episode of the Intraday Price Action Recap. This episode is being brought to you by the Smart Money Manuscript, as you all well know. Smart Money Manuscript is a course that I put together myself for individuals like you and others who may be interested in the stock market or who are already into the stock market, but you're just looking for something to help you get over that hump. Smart Money Manuscript is for you for $69.99. I think it's the best $69.99 you can spend on a course because not only is it jam-packed with 19 videos and 19 quizzes, you have the opportunity to get the Smart Money Mentorship, where every second Saturday we get together at 12 p.m. Eastern Standard Time, and I answer your hard-hitting questions. How important are your questions? That when you're studying something, you're taking a course, when you just being able to tap in to the creator and say, hey, Tim, can you answer this question for me? That is, I can't put a price tag on that. It's amazing. It's amazing. And since it's the last day of the year, I will share with you all that my little Tim Rogers brain has been thinking, but if you're from the country, like Deborah, thinking, my brain has been thinking that in 2026, sometime in 2020, in the early part of 2026, I am going to create a companion course to go alongside, in addition to the Smart Money Manuscript. And it's going to be called the Magical Fibonacci Tool. That's what it's going to be called. You're going to have the Smart Money Manuscript, and then you're going to have the Magical Fibonacci Tool, right? Now, here's what the Magical Fibonacci Tool is going to entail. It's going to give you access to phase 4 of the Smart Money Manuscript. Because before you can just learn how to wield the Magical Fibonacci Tool, you have to know about the ICT concepts. And phase 4 of the Smart Money Manuscript is me sharing my understanding of the ICT concepts. So, therefore, the magical Fibonacci tool, right? It's going to be a companion set for the Smart Money Manuscript, right? For the Smart Money Manuscript. And yeah, that's it. That's it. So that's coming. That's coming. The magical Fibonacci tool, right? And it's going to be focused on putting it all together, right? It's going to be focused on putting it all together. But I'm calling it the magical Fibonacci tool because the gang already know. Y'all already know. If you understand the ICT concepts, that amazing, wonderful Fibonacci, it's your roadmap to freedom. It's your roadmap to freedom, right? And there's several different things you can use the Fibonacci tool to help you predict, project, all kind of different things. But that Fibonacci tool, it is amazing. You feel me? But here's the gag. There's nothing really magical about any tool that you use on TradingView, in Thinkorswim, NinjaTrader, whatever platform you use to chart. There's nothing really magical about any of those tools. When you draw those little lines on the screen, the algorithm doesn't care anything about those lines. Those lines are just a visual representation of what you anticipate the algorithm to do based off of these amazing concepts that Michael J. Huddleston has so graciously shared with us all. So, hey, if that sounds like something you're interested in, when I drop the link, hey, help your boy out. I'm trying to bounce back from Christmas, man. Christmas set a brother back like a big dog. Set a brother back like a big dog. Who we got in here today, man? We got Joe up in here today. What's going on, Joe? We got Jim up in. What's happening? We got Jim up in here today. Jim, I saw your dissertation in the Discord, Jim. Jim, allow me to applaud you publicly. For those who don't know, Jim is really Michael Huddleston. He's been hiding in the group with us, while he's been on sabbatical away from the market. He's been hiding with us in the group. And Jim, when I tell you, your dissertation made me so proud when I was reading it today. I said, this is what doing the work looks like. Right? I can only take you at your words that you type, Jim. I'm not sitting there with you daily. I'm not asking to look at your trading log. I'm not asking to look at your P and that stuff don't matter to me. It's none of my business, right? So I can only take you at your words were so profound to me because I said, this is what doing the work looks like. And I not only thank you for sharing with me in the gang, I salute you with both hands for doing the work. Y'all give it up for Jim, man. Y'all give it up for Jim. Clap it up for Jim, man. We got light-skinned Deborah in the house. We got Yolanda up in here. We got Lumpford in the house. We got Lumpford in the house.
Better believe it. Happy New Year's, everybody.
Happy New Year's, everybody. It is the 31st. In just a few hours, it will be a new year. A little over 3.5 hours. It would no, little over 5.5 hours. It will be a new year. We got Here to Learn and Share in the building, the neighborhood spam bot. Yes, bad skin is a disability. Anything that you went to sick call for, where they can show that something that happened to you or you were exposed to in the military could have caused it or severely aggravated it, you can get disability payments for that. Yes. So bad skin is a disability. Yes. We got Venus up in here. What's going on, Venus? We got AJ up in here. What's going on, AJ? We got the Father of Legends up in here. Shout out to Father. We got the Father of Legends up in here. Happy New Year, man. Happy New Year to you and everybody. We got Rhonda Green in the building. What's up, Rhonda? We don't have Michelle. I wish Michelle was in here so I could tell Michelle about herself. Y'all ain't gonna believe what Michelle did today. I'm telling you, I'm gonna put you on Front Street because y'all know when I be telling y'all, people be DMing me stuff that they don't even need to DM me. Michelle want to take it upon herself. I shared something in the Discord today. As soon as I shared it, I couldn't get away from the computer and a DM popped in. I said, who DMing me because they see I done shared something in the thing? Click on it. When I go to my, what's the name? I see Michelle Tucker's face. I say, what is Michelle talking about? So I click on the DM, right? Michelle, I'm going to read exactly what it says. Michelle going to DM me, right? Michelle going to DM me. I want y'all to see I ain't swelling. I want y'all to see I ain't swelling, right? Michelle gonna DM me. She said, hey, Tim, my credit card got compromised, so I had to cancel it and get a new one. What do I need to do to provide my new card number for the gold membership that I have? How many of y'all ever, let me ask y'all something. How many of y'all ever gave y'all credit card information to me? How many of y'all ever gave y'all credit card information to me? So a scammer done got her credit card information and she had to cancel it. No harm, no foul. I get that. But then she told me something. What do I need to do to provide my new card number for the gold membership that I have? Michelle, you ain't never gave no card number to me. This question should have been addressed to whoever you gave your card number to get the gold membership, right? So, me being me, I said, man, I don't know. I don't work for WAP. But me being me, I said, I could check with their AI chat to see what they say, though. So I go in, I type in the AI chat. I say, how do I change my credit card info for a product with recurring billing? They said, you can update your credit card info for a recurring subscription by the following step, by these following steps. Go to WAP the place that I don't work for, .com memberships, sign in with your email address, click on manage next to your subscription, select update payment methods, tap add payment method, enter your new card details, and click add. Then she gonna hit me back talking. So you trying to tell me that I could have done that myself, huh? To be honest, I thought I signed up on your Discord. I do not remember that was a directly. Ah! Oh my God. Oh my God. Oh my God. This right here. This right here is the stuff I deal with. That's the stuff I deal with on New Year's Eve. On New Year's Eve. Hey, Tim, I don't work for WAP. I don't know. What did I say? I said, I'm transferred. When I transferred from just doing a YouTube membership to WAP for the Discord, I said, I'm transferring everything over to WAP. One, because I'm tired of giving YouTube 30%, because YouTube was taking 30% off the top, right? So for every dollar that I made, they took 30% off the top. They took 30 cents off the top, right? And then I said, WAP makes this an automated process where I don't have to do you sign. When you pay, they put you in there. If you don't pay, they take you out, right? Because people was getting over on me. People would sign up for 1 month, then they'll stop paying, and I don't know that they're not paying. And then 6 months in, I'd be like, wait a minute, this person not a member no more. When the last time they was in here? Go back and look. They be to pay for 1 month, and they've been in there for 6 months, soaking up all the game. So I'm just gonna make it an automated process, so I ain't got to deal with it. I ain't got to remember who here, who not, because I don't know when you cancel. I don't know when you sign up. I don't know. Right? It was a manual process, and I said I'm going to WAP to make it automated. But somebody, hey man, now that I done separated the wheat from the tail, right? All of the people that's just coming, just, you know what I'm saying, to try to hear me, to try to get me to use my crystal ball or whatever, they gone by now. They gone by now. Ain't nobody here now but True Gang Gang. Right? So now let's go over here and look at the price action. Did price do anything today that caught you off guard? If price did something today that caught you off guard, raise your hand. Right?
No, it's fine.
Yeah, it's fine. It's all good. You know what I'm saying?
Sorry about
Yeah. If price did something to catch you off guard, raise your hand. Right? Don't be embarrassed. Just raise wherever you're at right now, raise your hand. And then we can talk about it. We can talk about it, right? As we can see, price has drawn down into that liquidity pool that we talked about. Was it Monday? Monday. When we did the weekend chart prep, I stated that for a low resistance liquidity run, I would prefer to see last week's low stay in place. Right? That was Sunday afternoon, evening, whatever time we did the weekend chart prep. I can't remember. Sunday afternoon. Right? And after Monday's price action, right, I'll never trade silver again. It's like NQ and gold had an ADHD baby that's bipolar. Speaking of gold, Father Legends. The next time you see Empire Trades ain't in here. Next time you see Empire Trades, talk to him about gold. He asked me about gold, and I told him to go look at it. And I ain't seen Empire Trades since. Y'all, I think I done read Empire Trades off. I told Empire, I said, man, I got no crystal ball. Go look at it. Empire Trade said, everybody talk about gold. Go look at it then. Hey, y'all, I met somebody at the gym today, man. I met a new partner at the gym today. He a cool dude. I saw him in the gym the other day, and he had an assets over liability shirts. And I was like, that brother that knows something about the stock market. I don't know what he know, but I know he knows something about the stock market. He's been introduced to it because he had an assets over liability shirts, right? And for those who don't know what asset over liabilities is, that's a merch line that EYL had, still got. I don't know. I haven't followed their page in a really long time. And I was on the treadmill the other day when I saw him, and I said, man, if that brother's still in here when I get off the treadmill, I'm gonna go chop it up with him, right? And so when I got off the treadmill, I forgot. I was on the phone with mama, fired off, left. Then today I'm on the treadmill and I saw him, right? And I was like, if he's still in here when I get off the treadmill, I'm gonna go chop it up with him. And I was on my cool down. On the treadmill, and he came over to get, the little towels that you get inside Crunch, Planet Fitness, all that, and you spray the stuff on to go wipe down the machine. He came over there, and because on the treadmill where I be, my favorite treadmill is right next to one of those poles. And so he was over there getting a thing out, so I took my headphones off. I was, excuse me. And so we just started chopping it up. And cool dude, man, cool dude. And he like the rest of us, what I'm saying? He kind of got introduced to the stock market back in 2020. You know what I'm saying? We kind of shared a little bit of our story with each other, but a cool brother, man. And hopefully he tap in and tap into the gang and soak up some of this game that we putting out here on Al Gore's internet. You know what I'm saying? And he already on the right path for his young son, right? Him and his wife got a young son, a little baby. They got a little baby, got a young son. He already on the right path for him. So hopefully he tap in with the gang and soak up some of this good game, man. And what I'm saying? He can have his young king be ready by the time he get 18, just be ready to, what I'm saying, take it to the next stratosphere. You feel me? I just want to share that, man. I just want to share that call, man. They didn't teach us this stuff growing up, man. So that's all I ask of y'all, man. When it finally click up here and you can sit down and share it with somebody else and enlighten them, that's all I ask for y'all, man. Just pay it forward. Just pay it forward, because they ain't teach us this stuff, man. An old head told me one time, if you want to hide something from a brother, put it in a book. Sad but true. Pay it forward, man. Pay it forward. Pay it forward. You feel me? Hey, and he ain't say brother. He ain't say brother. He said, you know
No,
what
what he said then?
I'm saying? Hey, them boys got them smooth brains. You know what I'm saying?
Oh, okay.
Them boy, they brain be smooth, boy. They ain't got no wrinkles in it. Ah, they keep getting bigger and it rhyme with trigger. Hey, man. Like we said, after Monday's price action, right? After Monday's price action. So this is Monday, right? If we go back Sunday, when we did our weekend chart prep, hide this for a second. Sunday, when we did our weekend chart prep, let me hide this also. This was our charts, except for this daily high and low was over here, there and there, right? This, I'm not gonna move that, but this daily high and low was over here. This was our chart. And we said for a low resistance liquidity run, right? Want to see this stay intact, price retrace, right? To a discount of this range, and then continue up and draw into this volume imbalance and maybe even into the high, right? For the anticipation of the Santa Claus rally. All right. After Monday's price action, that's Monday. After Monday's price action, we said healthy price action from this point here would be, this is so far behind, it's killing me. Let me put this on live because I'm seeing stuff happen over there and it's distracting to me. I'm looking at the YouTube channel. It was like really far behind, right? Stated, healthy price action would be to come take this low, dive into this liquidity pool right here before going back up. All right. Healthy price action. And we also stated it does not have to happen, but based off of how the algorithm works, right? What does the algorithm use as rocket fuel? I gave it away. What does the algorithm use? Right? It uses liquidity for rocket fuel. I remember takeoff, the rocket, right? If you're bullish, you want to see a sweep of some level of sell side liquidity. And once you get a sweep of some level of sell side liquidity, right, you want to see displacement and an opportunity to buy in a discount, right? When you, let's go back. I just thought about something that we ain't talked about in a long time, right? What is it called? What, for lack of better terms, I'll say concept. I really don't have a good name for it, but what concept or part of the ICT concepts, what is it called when you're looking for very specific things like a move to a discount or premium, a manipulation of liquidity, short-term liquidity left in the market, either above or below price, right? Displacement. What is that called? Come on, Smart Money Manuscript. What is that called? You're looking for evidence of what? All these little clues that's left behind. That is evidence of what?
Say it one more time, Tim. I was talking.
Rewind the screen.
That's
When you're
light skinned
looking
Deborah help
for,
me out.
oh, light skinned Deborah definitely can't help you out.
Oh my God. I was
Yeah.
gonna say institutional sponsorship.
There you go. Give it up for light skinned Deborah.
Look at
Even
that.
though
See?
we know, Sherwin told her that. Sherwin told her.
Did not.
Institutional sponsorship. That's what it's called. Did I put that in the Smart Money Manuscript? Is that in the Smart Money Manuscript? Let me see. I'd have talked about so many different things. Is Smart Money Manuscript in the is institutional sponsorship in the Smart Money Manuscript? Because there's so many different things. We got power of three, order flow, displacement. I don't know if it's in the Smart Money Manuscript. I know it's in the art of reading price section. I know it's in the art of reading price section. But what is it under? If the power of three. Maybe it's in power of three. Let me check. Let me check that inside the Smart Money Manuscript. Maybe it's in the power of three. Because the power of three, it goes, the video is a lot different than the slides because it's extra stuff added in there on the video. Y'all help me out. Y'all know I got an old brain. There's so many different things that I done talked about. Y'all know I ain't gonna be able to stop now till I find it. It's not order flow. Why is this all out of order like this? When I be inside the order flow. It's not order flow. It's not if the. What we talk about? This is it right here. Intermediate term, balancing price, short term, buy side liquidity. This is right. Oh, right there. Institutional sponsorship. It's right there on the top. It's right there on the top. Right there. Why y'all ain't say Tim? That's what it says at the top. So it's in displacement on Smart Money Manuscript. That's what it is. Right? Here we go. What displacement looks like. Right? Displacement is not just this, is it here, right? How to identify institutional sponsorship. Right here. It's in displacement inside the Smart Money Manuscript, right? How to identify institutional sponsorship, right? The things you look for. You have what you look for long setups and short setups. Have y'all noticed with the ICT concepts, everything is just a mirror image of itself? The same thing you look for in the long setups are the exact same things you look for in the short setups. The only difference is you're either looking for it in a discount for long setups or you're looking for it in a premium for short setups. Right? Same thing. Same thing, mirror image, right? Just like when I taught myself how to play the keyboard, right? And I learned that there are 12 different keys. There's 12 different keys in music, right? That's it. There's only 12 different keys. You don't have any more, any less. You got 12 different keys in music. But if you learn 6 of the keys, you already know all 12, right? So it's like a lot of times we overcomplicate things because we be knowing stuff that we don't know that we already know. Because when it comes to music, no matter what key you play, right? Whatever the first, whatever the root note is for that key, right? Just say the key of C. The key of C is all white keys, right? You got C, D, E, F, G, A, B, right? And then C is the next octave up, right? So you got C, D, E, F, G, right? A, B. Those are the keys for the key of C. Any key that you play, if you start on the root note, if you start on the 6th note and play them in order, right? So now you got C, D, E, F, G, A, B, right? That's the key of C. But if you start on the A and just put them in order, A, B, C, D, E, F, G, that's A minor, right? So you have C and you have A minor, right? So whatever the 6th note is, because the 6th note in any major key is a minor key, right? And the 6th note is the relative minor to that major key. So no matter what, all you got to do is learn 6 major keys. If you learn the 6 major keys, now you know all the minor keys. And all you got to do is start on the 6 and just play them in order. And now you got a C minor. You got a C major and an A minor. You know it. You know the notes. That's the same thing when it comes to the ICT concepts, right? There's a lot of things that you know already. You just don't know that you know it because you're thinking so hard about, I got to learn so many different concepts. But all of these concepts are talking about the same thing. You don't believe me? You don't believe me? Right? We're talking about institutional sponsorship. Y'all bear with me. I'm doing this on the fly, right? Looking for long setups. Not only is it looking in between the long setups and the short setups mirroring each other, right? That's how I started out talking about how the keys, knowing the major keys, you got the minor keys, right? But for setups, you're looking for an intermediate term imbalance in price, right? You're looking for price to move to a discount or a premium, right? So you're looking for price to move to a discount, right? Or run on sell side liquidity, or move to a premium and run on buy side liquidity, right? What does that sound like? When you think about price moving rapidly into a discount, moving rapidly into a premium, moving into sell side liquidity, moving into buy side liquidity, what types of things are coming to your mind? Do you think about stuff like expansion? Do you think about stuff like manipulation? Right? Because if you want to go long and you're looking for price to move to a discount or move to sell side liquidity, and you want to see an intermediate term imbalance in price, what is an imbalance? When price moves so far in one direction, it didn't offer the same on the opposite side of the delivery, right? So that's a expansion. It's moving in one direction, right? If you're looking for it to take out sell side liquidity, but you want to go long, isn't that manipulation? Right? If you're looking for liquidity to be left above the market, right? If you look for liquidity to be left above the market, where's liquidity at? It's above swing highs, right? If you're looking for liquidity to be left below the market, where's the liquidity at? It's below swing lows, right? So if you're looking back and say, hey, I want to attack that liquidity up there. Why do you want to attack that liquidity up there if price is going down? You say, I want to attack that liquidity down there. Why do you want to attack that liquidity down there if price is going up right now? Right? What other concepts do that? Don't something like a market maker model have liquidity that's left somewhere that you anticipate price going back to? Right? You're going back to this swing high up. We're going down, Tim. I know, but we're going back to that swing high up there. Doesn't that sound like you're on the left side of a market maker buy model? And that left side of the market maker buy model is manipulation. And that left side of a market maker buy model is giving a imbalance in price to the downside. That left side of the market maker model is going and taking out sell side liquidity when it completes that market maker sell model, because you're on the left side of a market maker buy model, but you're on the right side of a market maker sell model. Right? And then you're looking for higher time frame displacement, reversals, expansions, return to fair value. Right? You're looking for price to do some type of Judas swing, some type of wig snatcher, some type of, it says it in there, retracement, reversal, expansion, a return to fair value, that's a retracement, right? And then, most important of all, time of day influence. So you're telling me that this institutional sponsorship is nothing new. It's just the same stuff that I already know, right? But it's giving me a systematic way to look for certain key elements to let me know that the elephant has stepped into the pool. And now I can start paying attention. I don't want to just be looking for a trade setup if it's just consolidating. I want to see an intermediate term imbalance in price, aka Pow! Y'all ain't heard that one in a long time. When the elephant step in the pool, Pow! Price gonna move. Which way did price go? Did it manipulate? Or did I already miss the manipulation? So now I'm looking for price to give me a reversal, then a return to fair value, right? It already manipulated. So now I'm waiting on the reversal and a return to fair value so that the next time it go, hi, I could be on the bus. Hush that fuss. Little Timmy Rogers on the back of the bus. Do you want to bump and stump with Buzz? Hey, man. Hey, man. Look here. That was Monday's price. I don't even know how I got on that. I don't know how I got on that. Oh, we was talking about what you're looking for, institutional sponsorship. That just popped into my mind. That segment was brought to you by Squirrel. So after Monday's price action, said healthy price action would be to take out that liquidity. That's how I got there. Because based off of institutional sponsorship, we are bullish. So when we start seeing price making a beeline towards sell side, we want to see it take that sell side. Especially if we have an imbalance down there. Because price, the algorithm seeks what? What are the two things it's always looking for? Somebody tell me. Somebody talk to me. It's always looking for what?
Liquidity and imbalance.
Liquidity and imbalances or inefficiencies, however you want to say it, right? This is a buy-side imbalance, right? Why? Because we only had buy-side delivery from this point to that point. This right here is a sell-side imbalance because we only had sell-side delivery from this point to that point. The market is moving in one direction. Overall, yes, we have wicks in here, but the overall direction is down right here. The overall direction is up right here, right? So that's an imbalance in price. Just like here, we had this sell side imbalance. Then the market came back and offered buy side, right? We went in one direction, then we turned around and went in the other direction, right? So once we see price moving towards sell side liquidity, what do we say? Don't try to force a reversal if we haven't taken out the liquidity. Let the market show you that I don't want that liquidity. I was just moving down here to engineer more liquidity for a later time in the future. Let it show you that. But if it starts to go toward liquidity, don't try to force a reversal until after that liquidity has been taken. Don't trust any retracements until after that liquidity was taken. If you come very close here and get discount sensitivity like this, once this day was closed, right? When this day wasn't here, take away this, when this day wasn't here, where was my focus? Was my focus here or here? Before Monday. On Sunday, when we was marking up our charts, before Monday played out, where was my focus? Here or here? Talk to me.
In the top.
My focus was right here. Very good. After Monday, where was my focus?
Taking that liquidity at the bottom.
Taking that liquidity at the bottom, right? And here we are at the close of the day on Wednesday. And where is price? Take that off, leave. Great googly moogly. That thing is juicy. Is that price down there? You know what this fair value gap said when price came down here? Said, did you miss me? Said, did you miss me?
I thought you said you ain't have no crystal ball.
I know, right? He called that. He
Yeah.
called that.
Telling on yourself now.
I do not have
Yeah.
a crystal ball.
Yeah.
What did I do? I need to open up. Do I need to open up the Smart Money Manuscript slides again? Do I need to open up these slides again? Right? We just looked at inside displacement, right? When we come over here, how to identify institutional sponsorship and long setups. You're looking for an intermediate term imbalance in price, a move to discount or sell side liquidity run, right? You're looking for a sell side liquidity run, move to discount, all right? Buy side liquidity, buy side liquidity left in the marketplace above price. Left in the market above price for pairing long exits. Y'all know what I'm saying, right? So if price is starting to move here, right, I want to see that intermediate term imbalance in price. So we're moving sell side only, leaving inefficiencies behind, diving into a liquidity pool. And when we came down here, right, this day right here, what did we leave up here? What is this? Right, we got a high. We got a high with a lower high to the left and right. What is that called right there? That's a swing high, right? What's above a swing high? Liquidity, right? A move to discount or sell side, and liquidity being left in the market above. On this day right here, right, we got liquidity in the market above price because price is here. Now, I just want to see it sweep the liquidity, right? Because I know the evidence of institutional sponsorship. So when I see one part of it and I see an opportunity to create another part of it, it gives me a high probability liquidity target, right? Does it have to hit it the very next day? No, it doesn't. But I don't take my eyes off of that liquidity or try to force price to turn around just because we got discount sensitivity here and then we failed to come take out that low this day. I'm not trying to be buying over here and say, oh, we're not going down there. We're going, oh, why? Because we haven't taken any liquidity over here on this time frame. Yes, we swept liquidity on the lower time frame there, right? But on this time frame, we haven't taken out any liquidity after this day right here, the day when we said, I want to come take out this swing low. This is liquidity on this time frame. So based off of evidence of institutional sponsorship, when I get one piece of the puzzle and I have another piece of the puzzle right there, I'm anticipating this piece to get collected. So now this piece has been collected, right? And not only did we collect that piece, let's go over here. Remember when I said, let me hide this line, that little line right there, right? Can y'all see what that says right there? That says 20-day equilibrium, right? What do you think that's for? Why I got that 20-day equilibrium right there? Who can tell me what that means?
I guess that's Consequently, well, that's 50% of your 20-day look back dealing range.
Exactly. Equilibrium. If I turn on my 20-day look back, that's my highest high. That's my lowest low for my 20-day look back. I don't want all those extra lines on my chart like this, because right now I'm just looking for when price moves back where? Well, I want to see a price move to what? What's that word right there?
Discount.
Discount. Discount. I want to see the price move to a discount. So I want to know, where is the discount of my 20-day look back? And not only do I want to know the discount of my 20-day look back, I also want to know the discount of my dealing range. There's the discount of my dealing range right there. Right? Why am I interested in the discount of my 20-day look back and the discount of my 20-day, of my 20-day look back and the discount of my dealing range? Because IPTA looks back in increments of 20, 40, and 60 days. So I want to know where I am as far as premium and discount 20 days back for my short-term trading decisions, right? I want to know where I am 40 days back for my intermediate term, 60 days back for my long term, right? But I want to know, where am I in a premium or discount for my 20-day look back? If my 20-day look back coincides with my dealing range, or even if it don't coincide with my dealing range, I always want to know where I am in reference to my dealing range. So my 20-day look back discount is here, right? My dealing range equilibrium is here. This suspension block right there splits the difference between discount and premium for my 20-day look back and my dealing range that I'm in right now. This is my dealing range here, from there to there. This bullish dealing range that we created right here, when we expanded up right there, right? Well, Tim, what makes that a bullish dealing range? We came down, took out sell side liquidity, we traded up, took out buy side liquidity, right? Once we formed a high up there, our dealing range is established. So we're looking for price to move to a discount. We're looking for price to move to on liquidity, right? So I don't own a crystal ball, but when you understand the concepts, you learn how to anticipate certain moves, right? And through the help of that magical Fibonacci tool, you can identify when you're in a discount or a premium. And based off the concepts, if you're bullish, you want to see price move to a discount, right? You want to see price move to a discount. And it was the same thing here when we was here, right? Y'all remember when we was up there? We talked about that, right? We talked about when price was up here on Sunday, right? We talked about when price was up here on Sunday, and we said for low resistance liquidity runs, we want to see price move to a discount of our weekly dealing range and move up, right? We're bullish. We want to see it move to a discount or liquidity, right? For low resistance liquidity runs, right? You don't want to see a lot of retracing. That's why I say for low resistance, we want to see it move to a discount of our dealing range and then move up. But when price moved down in the matter that it did and was showing signs of wanting to move into that liquidity, we said, okay, we're not looking for a discount of this range. We're looking for a liquidity sweep. That liquidity sweep will give us an opportunity to come back down to a discount of higher time frames. Tim, what's higher than your weekly, the monthly? No, you still got stuff like your 20-day look back, right? Because remember, IPTA's always looking back 20 days. You know, it's always looking back 20 days. And then when we go down to like our intraday time frame, right? And we notice that when we come into that liquidity there, right? When we come into, God dog it, Tim. When we come into that liquidity there, right? This is equilibrium of our 20-day look back, right? We notice we got liquidity resting right there inside of that fair value gap right there, right? So looking at that, you say, hey, look, we have liquidity inside a fair value gap. That's tasty to the algorithm. So if we come to a discount of our, we want to see it come to a discount of our 20-day look back, right? After we sweep this liquidity, right? And if we come to a discount of our 20-day look back, we definitely want to see it take that scrumptious liquidity right there. Especially since there is there a gap there? No gap. Right? Especially since there's an inversion fair value gap resting right over there. Right? And when we look at all this inversion fair value gap, this scrumptious busy right here on the hourly time frame, this inversion fair value gap and the hourly is there. And for those who don't know why I'm calling that an inversion fair value gap, is because when we look there, this is the first imbalance that was created before we came down here and swept liquidity, then came back and got this change in the state of delivery. So we're looking for that to act as an inversion fair value gap, right? So when we trade back down, take out the liquidity we're watching, get into a discount of our 20-day look back, and take that scrumptious liquidity right there, right? All of this right here, right? Let's come over here. Bullish fair value gap. Those are the quadrants, by the way. Bullish fair value gap. Remember that daily bullish fair value gap we were saying that split the difference between our premium and discount for the 20-day look back? What? Isn't it resting inside of there? Right? That busy is resting right there at consequent encroachment. Right? That SIBI right there is inside there. That's sort of in between the lower quadrant and consequent encroachment somewhere. Let's see. Yeah, right there. In between there. So this busy is stretching in between all three quadrants, right? And then this SIBI right here, it's like right there in between. So it's inside that area there. You know, you can break all that down into quadrants also, right? So you got a lot of stuff down there that the algorithm can draw into, right? Not to mention, there's more liquidity right there, right? There's more liquidity right there if the algorithm wanted to sweep it. And then, you know, remember, we also was paying attention to our, get on there. Our overall dealing range right there. Remember, we talked about that. And we said that the discount for our dealing range was here, was resting just below that discount right there. that inversion fair value gap right there, right? That inversion fair value. So that's more stuff that the algorithm can draw into, right? And we can look forward to support price there, right? Because based off where price is right now, we look like we might have, yep, we did. We fell just short of that, right? So we came down right close to consequent encroachment of the daily BISI, right? Our equilibrium for our dealing range is here, right? We got an inversion fair value gap there, right? Stuff where you're anticipating that to support price. And then we look over here, right? We have liquidity there. We can sweep. And then we also have, if price got really heavy, right? We formed a BISI and balanced price range right there. So when we come back down on this side there and we look back for confluence, right? There's a BISI right there that can support price also. But for the sense of low resistance on the larger scale, right? You really don't want to see price get all the way down here, right? You want to see price come back down into this bullish breaker. Whenever you have an inversion fair value gap inside the breaker, you want to see price come down to that inversion fair value gap to give you a better buying opportunity than the top of the breaker, right? This is your entire breaker. That's your inversion fair value gap. You look for price to give you a better buying opportunity inside the inversion fair value gap. So you want to see price firm up here if we want to get down into a discount of the entire dealing range. Right? No such thing as a crystal ball. But when you understand the concepts, when you understand, what two things do you need to understand when it comes to the concepts? It's two things. Don't worry about all them PD arrays. What's the two?
Price delivery and
Order flow.
There you
order
go.
flow. Okay.
Give it
Teamwork.
up. Give it up to the Wonder Twins. Give it up to the Wonder Twins. Order flow and price delivery. Right? Order flow and price delivery. So again, it's not about crystal balls. It's not about, hey, he called that. Right? I see people on Al Gore's internet that they talk. And hey, man, talk your talk. I love Deion Sanders. Deion Sanders talk his talk better than anybody I ever seen in sports because he can back it up. I don't toot my own horn, right? Because I'm just a simple dude from Fort Lauderdale, Florida, who learned a skill that changed my life. And I just share my understandings of it with everybody else. Right? If you want to talk your talk. But please be able to back it up. Please be able to back it up. Don't just talk and can't back it up. Right? So understand order flow and price delivery, and you too will be able to predict highly probability setups, highly probability draws on liquidity, highly probability anything. Because if price does this, then it should do that. Right? And I said all that to say, in the last 2 days, right? If you were trying to fight the market and buy, because on the higher time frame, we're in a buy program, right? You forgot about letting time and price meet, right? Because right now isn't the time, or wasn't the time on Monday, Tuesday, or Wednesday to be trying to buy. Right. Y'all remember on Monday when I told y'all I got beat all across the head and shoulders? Right. Monday beat me all across the head and shoulders. But today, one trade. I took one trade today at lunchtime. Like it was like just after 12. I had an appointment today. By the time I got home, it was like after 11. And I came in here about 11:30, 11:45 and was looking at the market. I said, this thing's setting up like I can get me a nice little short right here. This thing got some relative equal lows down there and it's taking off to the upside. That's looking like institutional sponsorship for a short setup. y'all see how Pinky Dinky do that thing and put that back in there we were just talking about? Institutional sponsorship. All right. Got me a little short. Went in with one contract. Got some displacement. Look for a fair value gap on like the 15-second chart. It retraced back into that fair value gap, added another contract. And that's all she wrote. That's all she wrote. One trade. Flawless. Now, guess what? Right? Guess what? Today, I took one trade. Flawless. Minimal drawdown. Worked perfectly. Textbook. Picture perfect. One trade. Now today, my P&L today was very similar to my P&L on Monday. And y'all already know what I told y'all about Monday. Monday was so difficult to me. So don't never think that your P&L is going to determine or reflect if the day was a good day or a bad day. Never do it. Right? And don't never let your trading day affect the rest of your day. Right? My brother in here. Y'all can ask my brother. My brother in here. But Monday I had a terrible day. Yesterday, I didn't even get a chance to trade. Today, I had a perfect day. But Monday, Tuesday, and Wednesday, when I was on my family call with my brother and my sister, my mama, I was the same OG. Same OG. Even though I got my own CD, you see me when I'm on TV. It ain't
Sing Genuine.
That's the same of the same me.
Take off the genuine.
Hey, of the same me, right? It's like I'd have been on the phone with my mom and brother, right? And we'd be talking, yucking it up, yada yada yada. And then I might mess around and tell my brother, be like, boy, look here. Man, I mess around and blow the account today. But just based off my attitude throughout the whole day, you wouldn't even never know that. You know what I'm saying? Because you can't let your P&L determine if your day good or bad. You can't let your P&L like affect your mood throughout the day. Yeah, it's gonna affect you. You know what I'm saying? We all care when we win, we all care when we lose, right? But you don't want to gloat when you're up. You don't want to sulk when you're down because you're putting too much emphasis on winning and losing, right? It's a marathon. Run a lap. That's what the tags say. It's a marathon. Run a lap. That's all I got, man. Anybody got anything for me? Do anybody got anything for me? Hopefully y'all found some value in this.
Man, we found value in every session. That's why we come to class. And again, Happy New Year's, everybody. About to hit it. I'm
Happy
going to
New
drink some
Year.
champagne and fall asleep on the sofa slobbing. Hopefully I'll be up at 12.
Hopefully, hey, boy. I was sitting up there on the couch. I said, let me take me a nap so I don't miss the New Year drop.
Man, it's 7:30 right now.
Oh, boy, look at her. Hey, boy, hey. When you get to be my age, boy, you be like, wait, what? Or say, what? Happy what? Oh, man, it's 2026.
It's slob everywhere.
Man, what? Hey, man, I appreciate y'all for hanging out with me, man. Again, remember, order flow and price delivery. Get that up under your belt, man. Understand why the market is moving to where it's moving, right? Is it moving toward liquidity? Is it moving toward imbalance? Is it moving toward both, right? And then submit to it. Let go of your desires of what you want to see price do, right? It's okay to have desires of what you want to see price do, but once the algorithm shows you what it's doing, if it don't align with what you want, either submit to it or wait until it aligns with what you want. You don't have to trade in both directions. You don't have to be a beast. Like me, I'm not a bull or a bear. I'm a beast because I trade both ways, right? I trade the opportunity that's in front of me. But if you only want to trade in a direction of the trend, you hear people say the trend is your friend. Wait for time and price to align. And when time and price align, strike. Just mind you, if you only trading with the trend, right, your trades are going to be fewer and farther in between. Right? Now, you're going to get opportunities where once it's moving in the direction of the trend, you might have an opportunity to add, put on shorter term trades, you know what I'm saying, continue to hold. When it's moving in that direction, you may have plenty of opportunities to keep adding and doing shorter term trades or just holding on or adding to your longer term. Oh, let me talk about that. When you are in a longer term trade, right? Let's just say you in like a 6 to 9 month position, right? You buy an option, you buy a call for like 6 to 9 months out, right? So many people have hammered into our head, you add to these positions when price breaks out or continues higher. Don't do that. Tim, what do you mean? I'm gonna say this and I'm gonna let y'all go. All right, I'm gonna say this and I'm gonna let y'all go. All right. So let's look at this right here. Just look at where we are right now today, right? Let's just say you decided, you said, hey, when we trade back down into this fair value gap right here, the next day I'm buying a 6-month call, a 9-month call, a year out call, right? So now we're here. Then you say the next day when we open up, I'm buying, right? I'm going to buy it. This low right here is going to be my stop loss. My profit target is going to be here, right? So we're entering here. Right, we're just going to say the next day, it just says opening up in the same spot right there. All right. Oh, let's put it just down a little bit lower. So remember, because we was looking at like the halfway point, and let's just say it gapped down and we got in just into a slight discount. Okay, boom. All right. So now we're saying that this is our entry, right? On a leap. We just say we bought a leap. All right. We bought a leap right here. Okay. And we said if price drops down below this low, get me out. All right. Get me out. I don't want to lose no more money, you know, if it goes below that low. Right. And the reason why is because we've created, right, an important low that I don't want to see taken out. Right. And then we've come right here and create this low, displaced up. Now we're trading back down into this imbalance, right? And we got relative equal highs here. Okay. Then said this right here is our profit target. All right. All right. So price comes in, we get in, right? Go down a little bit, and we come up like this right here. Now, they teach us, right? Right? They teach us when price breaks out above here like that, this is a good time to add more, right? Say, hey, we break above that high right there, add more right here. We're just gonna say once we break above that high, add more. All right. That is not what you want to do. Right? That's not what you want to do. You want to add when the algorithm gives you an opportunity to add where you should be adding, right? If you add right here, when price breaks above that high, where are you buying it?
In the premium.
Yep, premium.
You're buying in a premium because all we did was go up right here, right? All we did was go up. Now, notice this difference, right? Notice this difference. I'm going to leave that right there in the same spot. Price comes here and does this. That's when you want to add there. Right? But Tim, you're doing the same thing. No, you're not. No, you're not. Because now, right, if we look over here, right, you see this little PD array we got here, right? Once we come back up here, right? That PD array there is resting below price. And from here, we're getting a move into a discount because we have left a balanced price range here, and we're retracing back down into this bullish mitigation block right here. So now we're tracing back down, and now it's okay to add in this spot right here, because guess what you did by adding here after this versus adding here on the breakout? You getting it a lot cheaper, and you're avoiding giving back all these gains that you got here. And now you're about to make more money, because when you bought it here, it probably was $5, right? But once price goes up here and comes back down, it's probably $1.50 now. Right? So you bought it for $5. Price went up, came back against you. I bought it for $1.50. Price goes up. We both sell it at our target for $6 for the ad and whatever. This one down here was, just say we got it for $10, and now we're up here selling it up here for $25, right? So now you had one that you bought for 10 and sold it for 25, right? You got one you bought for 10 and one you bought for 5, right? So you $15 in, right? And you sold one for 25. You sold one for 25 and one for 6, right? So that's 31. Right? So you $16 to the good, right? And then over here, you brought one for 10 and one, what I said, $1. What I said, $1.25 or $1.50? What did I say?
$1.50.
$1.50. I'm $11.50 in. We both sold it for 25 and we both sold it for 6. Right? I'm up $19.50, but you only up $16 because the expiration that you bought here for $5, I bought the same expiration here for $1.50 because theta has changed the value of it when it came back down here to this same place. Right? So you never want to add to your position as it's breaking out. You only want to add to positions when price comes back to a discount after showing you that it wants to keep going. Right? And if, think about it like this right here. If price comes up here, and let's just say price come right here and somebody adds something there and you don't, and then it just keeps running up there, right? It just keeps running up to the profit target. Yes, they will make more money than you because they put more money at risk. But when it comes to risk to reward, right? When it comes to risk to reward, you're going to have a far better risk to reward than them because you're risking less money than they did and hit the same target, right? Because again, if y'all bought down here at $10 and then they bought here at $5, they in for $15, right? And you're only in for 10, right? And then y'all going to the same place. So your risk to reward is higher. Right? You're risking less capital, right, to make your gains. Right? And you only want to put money at risk when it's feasible. You don't want to just chase price and add on to it. Right? And
Can you mute Joe Tuma, Tim?
Oh, he got it. All right. I kept hearing something. I thought somebody was trying to talk. I don't know. 15 cents if you trade 0 DTE. Shout out to 0 DTE. 0 DTE out there getting the lotteries. Shout out to lotteries. shout out Stock Baby and Kiki with the lotteries. Lotto. What I was about to say. Oh, and then think about like this in the terms of buying the same position or adding to the same position or adding to your futures position, right? If you right, we'll come here. Wrong tool. Right? If you come here, that's our man. Look how that stop pop right there. How did it know that? How did it know that that was the stop? I just couldn't. It was like, how did it know that that was the stop? You know what I'm saying? So, right, that's our target right there, right? That's our target there. That's our entry. That's our stop. Okay. And so, if you add to the same position, right? Add to the same position, your entry price, right, is 23,000. I want to get that on the exact line. All right. So your entry price, okay, your entry price is 25,393.5, right? And so for all intents and purposes, we just going with one contract and we're going to add one contract to make the math easy right here, right? So if price went up to here, right? If price went up to here and you added one at that 25,974.75, right? If you added one there, now instead of your average cost being 25,393.50, okay, now your average cost, right, you have to add those two together because you put one in at 25,393.50 and you bought another contract at 25,974.75. You add both of those together, right? And the reason why I said easy math is because now that you put those two together, right? So that plus that equals, and then you divide it by 2. Now your average price is now 25,684, and we're gonna say in a quarter because it's above there, so it's gonna give you that quarter, right? So now your average price, what we said, 25,684 and a quarter. Now your average price is there. And you see the difference in the risk to reward? Down here, you're at a 2.5 to 1 risk to reward. And up here, you're at a 1.25 risk to reward when you just add right there, and then price just keep running off and don't come back for you. Now, if it went up and it came back down in futures world, right, don't nothing change about the risk to reward, right? It's just going to be the same. But in options world, because of theta and the other Greeks, you're getting it at a lower price than if you buy it the first time. So it don't equate out the same as far as the risk to reward, as far as adding on a retracement and options and adding on a retracement with futures, because with futures, the price is the price, right? If you buy it at 974 and 3/4, that's what it's gonna be, regardless if you buy it here, no matter when you buy it, it's that same price. But if you on options, if you buy it here and then you come back and buy that same expiration here, it's going to be a lot cheaper here than it was over there. Right? Everybody tracking, everybody understand. Right? So, and when you add to your position, as it's going up, right? If you add to your position anywhere higher than where you first entered, right, it brings your average cost up, right? If you add anywhere below your entry, it brings your average cost down. But what you don't want to do is for it to go past where your stop was. You don't want to move your stop, right? You don't want to come in here and say, oh, I got it wrong. Let me move my stop here to this low, let it come down, add a contract here, right? Let's see what that is. Let it come down, and I'm going to add a contract at that low right there. So that's 24,000. So we got our initial entry, 25,974.75 plus 24,616.75 divided by 2. Now my average cost is 25,009. 25,000. 25,295.75. 25,000.
On that initial been the 3, whatever that number
Oh yeah,
was.
I put the wrong number in there. 25. Hold on. Yeah, I put the wrong number in there. 20. I copied the wrong one. What was it? 25,393. All right, I copied the wrong number. That's the number I should have copied right there. So I was looking like, whoa, that's not right. Plus 24,616.75 equals divided by 2. Now that make more sense. All right. So you see, when I initially grabbed it, I was like pulling it down low. I'm like, wait a minute, that ain't right. All right. So 25,005. See, when I grabbed it, I started pulling it far down. I'm like, well, wait a minute, that's not right. 25,005 and a quarter. So now it brings your average cost. It brings your average cost down here, right? But what you've done is you've moved your stop, right? Because you were wrong, but you don't want to be wrong. And so you enter one here, move your stop because it was about to stop you out. And as price dropped, you added a contract down here. And now that drops your average cost down, right? So now, even if you got back to where you first entered, now you can close the trade with a profit. This is the type of dollar cost averaging that firms like Apex don't allow. They don't allow you to dollar cost average in to fight your way out of a losing position. Because now what that's going to do, that's going to not only make you break the rule of dollar cost averaging, because yeah, if it came back down inside here and you added a contract, there's no rule against that, as long as you don't keep moving your stop and adding contracts to fight your way out of a losing position, right? But if price came up and it came back down here and you wanted to add there, there's no rule against that. You can DCA within reason. You just can't continuously DCA to fight your way out of a position. And then you also want to be careful when you DCA in, because you can end up like me, where just say you put on one contract, it goes up and it comes back down, and you put on another contract, right? And then it goes up and it comes way down and just about stops you out. Now you got double the risk on. And so now, instead of risking, let's just say you're risking $500 right here, instead of risking $500, now you got two contracts on and you're risking $1,000. And if it come all the way down here and almost stop you out, then you may be risking more than 30% of your available balance. And that right there gets you. That's breaking a rule too. I can't remember what it's called, DEA or what, I can't remember what it's called, but you're risking more than 30% of your balance on one trade because you've scaled in and you get a deep pullback into the red. And so now they're saying, hey, you're leaving this open. You're risking too much money on this one trade. So always know the rules of the prop firm that you're trading with and how to engage accordingly. Okay. I don't know how I got on all that, but you know what I'm saying? Hopefully y'all got something out of that.
Yeah, that was good. Yeah.
Right. So especially for those that trade options, right? You always want to know when is a good time to add to my position. Right? When is a good time to add to my position? When is it a good time to hedge against my position? Right? For example, if this week, let's just say, right, you bought when it pulled back down here, right? So you bought one because we was watching some weekly PD arrays down here. Let me see. We was watching something over here. I know we had this order block right here, and it was something else we was watching. Right? It was something over here we was watching. We just gonna go with this order block. I can't remember exactly what we was watching, but we're going with this order block right here. Right? Whole order block. We're gonna say the whole order block you bought at mean threshold of the whole order block, right? You bought here. Okay. You bought here. right there. That's where you bought there. And you said, if we come down to the close of the order block, get me out, right? I don't want to risk all the way down there because that's going to be totally invalidating everything and I'm totally wrong. But if we come down to the bottom of the order block right there, get me out. And this is my target up here, all-time new highs. And you bought a, uh, this is December 2025. So you bought a January 2027 leap, right? That give you like a little over a year, right? So you bought a January 2027 leap here when price came down into this right here. All right. Now, looking at our daily chart, where did my thing go? See anything. Now, looking at our daily chart, right? Okay. And now, based off what we said this week, right? All right. Based off of what we said this week, right? All right. So based off what we said this week, we said, hey, for low resistance, I want to see price come here and continue higher, right? I want to see price come here and continue higher. Monday went by. After Monday, when Monday went by, our attention was turned here, right? So at this time, Monday evening, you can say on Tuesday, if price comes up into a premium, I'm going to buy puts for this weekly low, right? And I'm going to buy it for either the end of the week or next week, short term, right? I'm going to buy puts for the end of the week or the next week, short term, to hedge against my position where I'm giving back profit right now, right? So then Tuesday comes in, right? At some point in time, it went up. Let's go into the day to see if it fulfilled our requirement. Let's go down to a 60-minute chart, right? And we're gonna find 9 o'clock. 9 o'clock here. So it fulfilled our requirement. It went up into a premium during 9 o'clock, right? 9 o'clock, we went up above this buy side. So we came up here in a premium during 9 o'clock. We bought puts for this low here for the end of the week or next week, right? And then today, right? We got today, and then, right? This was our target price, right? That was our target price. Let's go over here to SPX, right? This was that low. Let me go back and see which low was. I'm looking at SPX. Let me look at the Qs. That low right there, right? So we got puts for 617, right? When we popped up here, we bought 617 puts for that low because that's the low we're looking for price to take out right there, right? The low of the 23rd, right? Low of the 23rd, bought 617 puts right? To hedge against the gains that we're giving back here from this rally, because we bought down here, right? Hedge against that rally, right? That against that pullback, right? And then today, right, we've exceeded our target there. Now we can take that off. Whatever it is, this is 617. And down here, just say we got down to 615, 614 something. Just say we're roughly $2 in the money. All right. So whatever you paid for it here, right, for later in the week or next week, now you're at least $2 in the money. So that's going to be $2 plus whatever theta you got left on that, what's the name? And then you close that out, right, today, because why? You've hit your target, right? You waiting toward the end of the day to see how much juice you can squeeze out the lemon, because today is just going, it's showing you that it's going down. You're expecting it to go to a discount of your range, right? You got targets, you got stuff that you're looking for. You got sell side liquidity, right? You got sell side liquidity that you're looking for price to trade into, right over here. That was the, yeah. You look for price to trade into that sell side liquidity, right? You got other stuff down here, so you just holding it to see how much juice you can squeeze out the limit, because you've hit your target, and now you're holding it, waiting for it, because this right here is during the 9:30, right over here, right? And it's at night because you bought it over here, and at 9:30, price open up, and now you below your target, and you're waiting for it to go down to those lows down there. And then when it get time, you get down there, it's time to close everything out, going to the end of the day. Boom, you close it out right there, right? And now it closed at 614, right? And that's right at the end of the day. So let's just say right around here, right? You say, okay, that's good right there at 3 o'clock, right? At 3 o'clock, you're looking at 614 and 3/4, right? You say you're looking at 614 and 3/4 when we said we got in at, our target price was 617 or whatever that was, like the low from that day. Right. That was 617.77. And so let's just say $3, because you know what I'm saying? $3. So you're $3 in the money, right? You're $3 in the money plus whatever theta you got left, right? So you can close that out for your $3 plus or whatever it was. You know what I'm saying? So if we go over there, let's go to bar chart real quick. So look at actual numbers. I'm just making stuff up in my head. I don't know how much it is. Let's go to options, option prices, and then we're going to get a 617 or 618 strike. We're going to go to expiration dates for the end of this week is the 2nd. The end of next week is the 9th. So we'll just look at both of them. So January 2nd, right? January 2nd for a, and what do we say? 617 for a 617, 618. All right, we can look at the 618 because it was 677. Right. So 618 put on it's not showing it to me on there. How do I get to the chart? This is the 31st. That's today.
Go to those dots on that right side, and then you'll right click and it should give you an option of chart so you can see the pricing.
Oh, right here.
See
Okay.
yeah. Right
Yeah.
click,
So
and I
this is
think it'll say
618.
chart.
All right.
Then it say options chart. Yeah.
Yeah. All right. So, all right. So this was, let me see. I can't make this bigger. Oh, yeah, there you go. All right. So when was that? Yesterday? What did we say? Yesterday? Yeah, we bought it on Tuesday. All right. So Tuesday was the 30th. Right. So on the 30th, we bought it on Tuesday. Right. So it opened. It opened at 231, got down to 115, and it closed at 189. Right. So this is when price popped up. So we're not going to go to the low and we're not going to go to the close because it's somewhere in between here. We didn't buy it at when it spiked at the high, and we didn't buy it when it closed. So we're going to go in the middle somewhere and say 160. Right? We're going to say 160. Okay. And then when we come over here, right, then it right there, it closed at 425 today. Right? It closed at 420, 421 today. So we'll just say you closed it at $4. Right? So they go some real numbers for this week right here. Right? This week's expiration right there. Right? Paid 150 for it and then sold it for $4. Right? And then next week's expiration, right? Because the further out it is, the more time value they give you, right? Next week, the 9th, right? Come over there, options chart.
That's the
That's a
call. You wanted to
call.
do a call? Yeah.
No,
Okay.
yeah, I clicked on the wrong one. 9th, the 9th, all right, options chart, right there. And then 29th, all right. So on this one here for the 30th, all right. So again, this one here, and look at the difference in the price. You see how the difference in the theta, how it moved around. Remember how much the theta changed? I mean, the value changed on this week. Look how much the value from between the open and the close, right? So on this one here, it opened less than it closed for, where the other one opened more than it closed for, right? It got all the way down to $4, right? And so we're gonna do the same thing. We're just gonna come here in the middle somewhat, pick a good price right there. Just say 440. That's good. Cause we ain't get the peak, we ain't get there. So easy math, 450, right? 450, right? And then over here, we closed it close to the end of the day, right? And we come down here to the hot, it closed at 739. So we'll say 725 because we waited to close to the end of the day, and then around 3:30 we said forget it. So from 450 to 725, right, is how much we made with real time, right? So that's like close to $3, right, on that one thing in one day, right? In one day, because you hit your target, right? You hit your target, and 450 divided by 725, right? 62% return in one day, right? Can't beat that on a trade, but that's a way you can use that. It's not about like how much money you made, but that's a way you can use the concepts to do like a short-term hedge, right, against a position that you're already in and making money during a pullback, right? And then that money that you made during that pullback, right? If you believe, hey, I want to buy when we get down here in this area right here, right? That money, that $3 you made on that right there, now you can put that toward something that you're buying down here in a discount to add to that position. And what you can do is, instead of buying another 12-month leap, right, you can put that money towards a 6-month option, right? So you made money on the downside, a quick flip, then take that money and add it into a 6-month option where you say, I want to buy in this area down here, get me out. If I hit this low right here, right, you can add that money to there, get me out. If we take out this low right here, and then, you know what I'm saying, you can either target the same high or this high. And now this 6-month option that you bought is going to grow exponentially in reference to this leap that you got back over here. And you made some or all of the money from a hedge that you put on against the longer term play that you had, right? And that's how I used to play my options portfolio when I was trading options, based off of the ICT concepts. Hopefully that was helpful.
It was.
Yeah.
It
Sounds like
was.
you're gonna be doing a Fibonacci masterclass and then how to trade swing options masterclass afterwards. Appreciate it. Appreciate it.
Nah, I ain't go best. I lead the options masterclass up to Wall Street Trapper or somebody. I ain't gonna do the because I don't trade options no more. So I only talk about what I do. You know what I'm saying? I know how to do it, but I only talk about what I'm doing right now because I want to put 100% of my focus into it. You get what I'm saying? And I could
So
talk
in your
about
opinion, from your personal, I get it. You it was too much of a split focus for you. You think you compound money for you personally, compound money better with futures, like you said, because there's no theta and stuff like that. You can get in and out rather than like a combination of swings plus futures. You still feel like you get more for you personally, bang for your buck, just concentrating on futures.
no. For me, my problem was it was too difficult for me to trade my futures in the short term against my options positions. So let's just say if I got into a call on Tuesday for my options, right? But price was showing me that it was going to keep pulling back throughout this week. You know what I'm saying? Because when I buy options, in the beginning I was doing same day, but then I had got to the point where in the beginning I was doing like swing trading. Then I got into same day options, and then I went back to swing trading. And so if I'm buying 2-week options and it's pulling back throughout this week, I found it difficult to short futures. I was trying to force longs because I was in a call, or if I was in puts, I was trying to force shorts because I was in puts. So it's like it was hard for me to separate the bias, even though the option may play out, right? But the futures is less forgiving on how much room I can let it run throughout the day. So I'm getting chopped up in futures. So that's why I move solely to futures. But if you can separate those biases, it's absolutely phenomenal to be able to trade futures to build the capital, trade options to grow the capital exponentially, and then take that exponential growth and put it into buy and hold. That's the trifecta. You see what I'm saying? But if you can't separate those biases, then it's better just to trade one to grow your capital and then put it into buy and hold. Make sense?
It makes sense. So even like those perfect situation you just can't, like you showed with a swing, because obviously we retrace, not saying it's guaranteed, but that retracement into that, we hit that ARP and into discounts. So now is a great time. So speak of your bias is bullish to go ahead and buy that six. So even with a 6 month swing, it was still affecting your bias, or you'd rather not have your money held up in a swing?
Like I ain't been doing leaps. I was only doing short-term swings. I ain't done leaps in forever. Now, it didn't affect me as far as my leaps. It was just my short-term, like 1 week and 2 week option plays that was affecting me. So if you're buying like leaps and stuff like that, that's a total different beast. You know what I'm saying? Like, if I just don't trade options no more, because I just like to focus on one thing. And if I'm trading options, then now I got to worry about something else and trying to put money. I'd rather just make my money and then put it into buy and hold. That's just a personal choice. That's just a personal choice. You know what I'm saying? So if you talk about like trading leaps and then day trading options to make the money, oh, that's perfect. That's like the perfect setup, because nobody can just beat the market every day. So you need that way of just saying having a long-term position to help grow your money exponentially. And buy and hold ain't gonna grow it exponentially. Those options are gonna grow it exponentially. You see what I'm saying? Hello.
Yes, that makes, sorry, yeah, that does make sense. And I, like I said, especially if you can put in an order on that option, when you, like you say, you can set those OCO extended orders and have that, like you say, just playing out on its own, where you can still focus in on the futures every day and know that that option is just kind of working in the background, and you set your limit, and of course you checking on it if you need to move stops up and so on and so forth. So
Yeah. And just like right now, if you look at the if we look at the Q's chart right now, right, and we put it on, let's look at a
Let's
weekly
do
chart.
it.
Right. We look at a weekly chart right now, right? So we look at the weekly chart on the Q's, okay? And so
Show your chart.
oh, right. So me looking at the weekly chart on the Q's, I said, okay, I'm looking at this here. We're getting a pullback. First thing my eye come to is this wick right here, right? I don't know why that line is there. Why is that line there? I don't know what that's for, right? First thing my eye come to is that wick right there, right? So we got one trading day left this week, right? So I'm looking to see what this week does, right? I say, okay, I got this wick right here, right? And I'm watching, right, the quadrants of that wick right there. So now I make up in my mind right now today, right? If we hit 608, round 608, because that's 608.67. If we come around 608, right, I'm buying a 1 year leap, right? And I don't tell people how to buy their calls or puts, right? Me, when I was trading options, I typically bought at the money. So if I say we hit 608, I was buying a 608 call, right? But you can also play it for, I'm buying the high as my strike price. I'm buying 2% as my strike price. However you choose your strike price, you know what I'm saying? That's up to you. Out the money, at the money, or in the money. In the money, you buying a strike price lower than where price is, right? So if we hit 608, right, I'm buying calls because I'm looking at this wick right here, right? And that's consequent encroachment of this wick. So 612 is the upper quadrant, 608 is the lower quadrant. How strenuous you want to be on it, right? But I say, okay, we hit 608, I'm buying calls, and I'm buying a January 2027 call, right? January 2027 call if we hit 608 on the Qs. Okay, so let's just say Friday, we continue to sell off and we do hit that right there, right? I buy it. Okay, now, right? Since we got that low, I'm going to allow for price to go there, right? But if price come down here, I'm just going to accept that I'm dead wrong. And I'm going to get out, and then I'm on. You about to go to, okay. And then you're going about, what's in that house too? Yes, sir. All right, be safe. It's New Year's Eve. Don't be out in the streets. All right, love you. Yeah, see you next year. All right, so.
You said you accept for that wick to be, it can go that low, but you putting your stop right underneath the body. Is that what you were saying?
Yeah. I was saying like,
Okay.
okay, if I get in at 608, right, there's liquidity here that the higher time frame can take, right? So I'm allowing for it to take that, right? But I don't want to see it coming down here. If it come down here, I'm accepting that I'm wrong. I'm going to get out and look for a better position under these lows, right? I'm not just going to eat, and then let it recover, right? If it get down here to the close of that order block right there, just go ahead and I'm going to get out. And then once we sweep that low, I'm going to reposition down here somewhere, right? But just looking at this right here, right, I'm not anticipating that much of a fall. You see what I'm saying? Because for the Qs right now, right, that'll be over 5%. You see what I'm saying? That'll be over 5%. And so I'm allowing for it if it wants to get heavy to take out that. But I got 12, I'm going all the way to, I got 12 months for it to recover, right? And based off of the price action, right? I definitely don't want to see us losing this order block right here, right? So if we came all the way down here into this rejection block, right? That's going too far, because let's look inside of this weekly candle right here, this weekly wick, right? Go down to our daily chart, right? So inside of our daily chart right there, see how I look on the daily, right? That's liquidity that could get swept if the algorithm wanted it, right? But this right here is the low of that order block, right? And that low right there, right, is a protected low on the daily time frame. Okay, so I'll allow for it to go there, right? And if it came down here, if it hit, and looking at this right here, right, we got a suspension block right there. We got an order block here. We got a daily order block there. If we did get down there to that 608 where I wanted to go, I'll buy it, right? And then if we did come sweep this right here, right, I may even add something, right, not to this one, but to another strike price, right? Add something to another strike price right here. Or I might even add something to the same one, but I typically would add not something to another strike price, right? I add something to another strike price here for like 6 months out, right? I got this one here for a year out. And if it came all the way to the liquidity, right, I would add something here at another strike price 6 months out, right? And again, both of them, if we get all the way down there, get me out, I'm wrong. Okay. And then that way,
Why 6 from the deeper place and not
because
a year from the deeper and a 6 from the original? I guess
because
yeah.
the 6, because I want to get in for my leap. But if it gives me a deeper retracement, I want the exponential growth from down here. I'm gonna gain money exponentially faster from down here off of 6 months because it's gonna the value of it is gonna increase faster over the 6 months than it is for the 12 months. Because remember, right, if I come down here, right, at 600, right, if we come down here and I buy we hit this low and I buy a 600 call, right, up here I bought a 608 call, right, I buy a 600 call right here and it's for 6 months out, right. Once I get back to where I bought my original one at 608, I'm $8 in the money already. You see what I'm saying? And so as it moves, right, because I'm buying at the money. So at every time I go up $1, it's increasing at least $1 because I'm in the money now, right? And so I'm at $8 here, right? And so as it's moving, when I get, just say if I get back to this high, if I get back to that high 3 months later, I still got 3 months of time value on top of the fact that now I'm $25 in the money. You see what I'm saying? Because I bought a 600 call. So I'm $25 in the money plus whatever that 3 months of time is worth. Just say the 3 months of time is worth $5, right? Say the 3 months of time is worth $5. And so now I'm, selling it for $30, right? I'm selling it for 30 because I'm $25 in the green and it's $5 worth of time. That I'm just guessing on the time, but it's $5 worth of time, right? So it's growing exponentially faster because the reason why I'm going shorter time when I buy down here is because I'm recouping this drawdown as I'm coming back up, right? Instead of just suffering back up, I'm making money on the way back up, right? And so now I've covered all of these losses. By the time I get back to where I bought this one here, instead of being still in the red, because if I buy here for 12 months out, drop down here, when I come back there, it's not the same price. It's less than what I paid for it, right? But if I buy down here, right, buy there and then buy something else down there, no matter if I buy 6 months or 12 months, when I get back here, this right here has covered, I'm back in the green overall. I'm back in the green overall. But if I bought this for a shorter amount of time, I'm more in the green. You see what I'm saying? I'm more in the green than where I was over here, because if I buy it for 6 months, I'm paying less money for it than if I buy it for 12 months. So I got less money at risk, but I'm gaining more money off of the shorter time span. You understand what I'm saying?
Yeah, that makes a lot of sense. Okay. Well, I say, can't wait for this class after the Fibonacci. All right. Yeah.
I'm just talking about the way this is just
Oh,
how
you
I
sound
used to
like
trade
you
options.
creating something. Yes.
This is just how I used to trade options. When I was trading options, this is what I did. I'm just
Coming
sharing
into
with you what I
2026,
did.
manifesting. Manifesting this
Yes.
class. Yes, I see it already in the
Yes.
future.
Sign me up.
This is what I did. This is what I did on the what's the name? When I was trading options, this is what I did. So, and I know everybody is not, and the reason why I started talking about this tonight, right? The reason why I started talking about this stuff tonight is because I realized that overwhelming majority of the gang it are people who can't just sit down and day trade futures every day, right? They look for opportunities where they can put their money to work in the market as far as a swing trading perspective, right? And I believe that the best way to grow your money exponentially if you're swing trading is with options. But you know what I'm saying, you have to understand when to buy it, how to buy, because if you just do it wrong, you stand to lose money exponentially. Right. And we all went through that back in 2020, 2021. 2020, the market was going straight up. All we had to do was just buy anything. It was just going to go up and you're going to make money. But when we got into like late 21, 2022, and the market started actually giving you ebbs and flows, we lost a lot of money. Right. So you want to be able to understand time and price. When should I buy it? When should I sell it? When should I hold on to it? You know what I'm saying? And you don't want to be buying on breakouts. You buy on breakouts, you run the risk of having to sit through severe drawdown. And in 2020, we was buying on breakouts. We just came in and bought anything, and the market was just gonna go up for 3 weeks straight. All right. So, and you can't do
Yeah, it was the best of times and the worst of times
it. Yes.
because it did not prepare us for real trading. I'll say that. And
Yes.
unfortunately, the downside is it scars you from, well, me personally, from really even wanting to even do like you just explained there. Because my original plan was to have futures in the day and swings, option swings running in the background, but it just kind of make you take a step back. But now that we learn real price action, I see the light again because
Yo, that's what's
I'm
up, man.
telling you,
Shout out Yolanda, man. The light, it's starting to, I can see clearly now. The rain is gone. Hey, and it's when you start seeing that light, when you start moving in that direction, right? Start with baby steps. Start practicing your strategy. Right. Start practicing your strategy. If you ain't started already, start paper trading your strategy. Right. Do that for a few months and see how effective it is. And then if you say, hey, this pretty effective, you know what I'm saying? Then start to nibble. Start out small. You know what I'm saying? Maybe start out, you know what I'm saying, with like one leap, right? Get you one leap, and then like every quarter, look for an opportunity to buy maybe a 3 to 6 month call. Don't even try to go into the fancy hedging, right? Every quarter, look for if it's going to a bullish quarterly shift, right? When you get into a quarter that's like pulling back, right? You say, okay, I'm coming back down to a discount. Now I'm gonna start looking for opportunities for more call setups to get me a 3 to 6 month option, right? So you may have an opportunity to put on one leap and maybe two short-term options throughout the whole year. You know what I'm saying? But what that's going to do is that's going to afford you time to be saving money to prepare to buy that option when time meets price. You see what I'm saying? Because you don't want time to meet price and you ain't got the money in your brokerage account, right? So, and even if like right now, right, we're seeing where prices we're in a buy program and prices moving down to a discount, and it's looking like, okay, a buying opportunity is right, right here on us, right? You might get in now and it take off. You might get in now and it pull back a little bit, but we're moving down to a discount. We ain't at the top. You know what I'm saying? It's a possible buying opportunity here, right? We got an intermediate term low down there back in, what was that? November. We got an intermediate term low back there in November. So, and we're coming back down into a discount of our current price leg, right? We may sweep out one level of liquidity. So if I get in now, I might go through a little drawdown, but I got a year to recover, right? And that's going to prepare me for the next quarter one. I might be getting an opportunity to buy a short-term call because we coming up on the end of quarter four. Quarter one, I might get an opportunity to buy a short-term call. But if you don't have the money right now for that, you can start preparing now, and you can say, hey, I don't have the money for a leap, but if quarter one presents me an opportunity for a short-term call 3 to 6 months out, I can get this call now, right? And then I get it for 3 months out. I can sell it if I hit my profit target in a month and a half, right? Because I want to hold it no more than half the amount of time that I bought it for, right? I want to hold it for no more than half the amount of time I bought it for, unless I buy at the money and I'm already deep in the money. Because if I buy out the money, it's going to take time for me to get in the money. So it's going to be eating away at my time trying to get in the money, right? And then once I get in the money, I don't want to wait too long to start letting that time value disappear on me, right? So Q1 offered me an opportunity to buy, right? I buy in Q1, right? Sell it in Q2, right? Sell it in Q2. If Q2 start presenting a pullback, right, look for something to buy going into Q3. But if Q2 keep running and I sold in Q2, who cares? Let it keep running. I made my profits off this right here. I'm still saving money because I want to get that leap, right? And then if we start pulling back in Q3, right, and when we're going into the like late summer, we start pulling back in Q3 when we typically get that pullback time, right? Now I've been saving my money, and I probably can get my leap, and when I'm in a discount in Q3 and another short-term option, you know what I'm saying, getting ready to go into Q4 because I've been saving my money. I made a little money off of the one I got in Q1 and sold in Q2. Now in Q3, when we get a pull back in Q3, because it's going into that bearish time of the year, now I done saved enough money along with what I made off of there to get a leap and a short-term option play. You know what I'm saying? And all at the same time, I'm still day trading my futures, right? All you gotta do is formulate a plan and then execute your plan, right? My plan is day trade futures and then just invest long-term for my kids. That's all I do. I'm 53. I ain't got time to be investing long-term for myself no more. I'm enjoying my money. You see, I'm trying to bounce back from Christmas. But my
Did
kids,
you
did I
in
what?
your experience, did you like you say, same plan when you were doing it, did you just concentrate since on like the cues since it's aligned with the futures we already looking at? Or did you have like a set of 3 to 5 uh tickers that you looked at for a swing?
I did. Initially, I was starting with like companies, but with my leaps, it was always the SPY. Right. It was always, that's where the spider game come from. SPY, SPYGANG, spy, SPYDER, spider. That's where the spy come from. Right. Because I used to swing trade the SPY. It was always the SPY because the ES and the NASDAQ move similar the same. So the ES and the Qs, right, they're going to be closely related with like what they're trying to do. They're correlated. But I used to always buy my leaps on the spot. When I initially started, I used to do individual companies like, it was mostly like tech companies, tech ETFs, like XLK, SMH, um, Apple, Apple, XLK, and SMH. Those was the 3 ones that I used to like do options on the most. And the SPY and the SPX was like my daily options. That's what I used to do with daily options. The SPY, because I was doing the SPY, and then once I realized, I'm like, man, I'm buying. Matter of fact, Lex was like, Tim, if you buying 15 contracts on the SPY, won't you just buy one contract on the SPX? And I was like, the price, right? She was like, it's just the SPX is just 10 times the SPY. And if you buy more than 10 contracts, just buy one SPX, you will make more money. And she shouldn't have told me that because I went ham. But yeah, so and if like for you, like, you know what I'm saying? This is what I advise to anybody with kids, because this is what I do with my kids, right? Open them I use Vanguard because I can set up everything automatic. Open up them a Vanguard account and just buy the market. I buy I got a Vanguard. It's a Vanguard fund for their main investing account, right? Their main investing account is a Vanguard fund that track the SPX. And for Timothy's Roth, I just buy VOO every month because it tracked the SPX, but it's an ETF. But with Vanguard, you can do fractional shares with VOO, and with the Admiral shares that I do with them, you need a minimum balance of $3,000 to open that account, but you can invest whatever you want. You can do $50 a month, right? Because that's what I started out them doing, $50 a month. I put 3,000 in there and started doing $50 a month, and it's automatic. It just go in and automatically invest. With Timothy's Roth, right, I do $50 a month, but with the Roth, you have to do it different. You have to do an automatic transfer into the account, and then you got to do an automatic payment of $50 a month. Just tell it to buy $50 worth of VOO every month on this date, right? So you got to do 2 automatic setups when you're buying the ETF. But if you do like the mutual fund, the Admiral shares, or whatever it is, whatever their fund is, you can automatically put the money into that fund, and you only got to do 1 automatic setup. And I tell everybody, I just say buy the market for your kids, because the market predisposed to go up. And this year, I think the SPX, I think we hit like 17%. Let me see, what's the day? The day 31st. So let's see what we actually hit on the SPX. Right. So we go to the SPX and go to the year. Right. This year, the SPX, we hit 16.39. So 16%. We ended the year up 16%. I don't know any bank account that's giving you 16% return on your money. You know what I'm saying? That's what the market predisposed to go up. So I just buy the market for my kids. You know what I'm saying? So and I just dollar cost averaging every month, just put a little bit of money in there every month. And that way, you know what I'm saying, by the time they get to be adults, especially with people who got small kids, by the time they get to be adults, you just putting a little bit of them, you putting $50 a month in there from when they 5 up until when they 18, you know what I'm saying? And you know what I'm saying, you averaging good returns. We back in 2022, that was that year that beat everybody across. I was just talking about 2021, 2022. I lived it. See, when I said when 2021, 2022 came around and it busted us across the head, what it say? The market was down 19% in 2022. That's that year that busted us across the head. You see what I'm saying? It busted us across the head. But since then, we had a 24% year, we had a 23% year, and then this year we had a 16% year. All right. So
yeah, I have it through Fidelity. It's a uniform UTMA
yeah.
account through them. So I set them up with that already. So like you said, but just averaging in.
Yep. And I got a UTMA with them through Vanguard. Both of them got a UTMA, and then Junior got a Roth. Junior got a I did a UTMA with Vanguard, and then when Junior started working, I got him a Roth. And that little Joker been slacking over the last. I said, Junior, it's been a few months since you put any money in your Roth. I know I've been slacking, Dad. I've been slacking. He ain't been slacking on going on dates with his girlfriend. Like, cause he used to come here, he's coming every month. Hey, Dad, let me log in. And cause when he got his job, I told him to set up a login so he could just go put money into his Roth itself. And what happened when he put his name in the system, it automatically linked both of his accounts to his UTMA and his Roth. And because he got a UTMA on there, he can't personally make any transactions because he's not 21 yet, right? Because in Georgia, you got to be 21 before you can take over the UTMA account, right? And since he's under 21, he can't take it over yet, and so he can't contribute any money through his login. So he got to log in my name to make the contribution to his Roth. Now, if he didn't have a UTMA and he just had a Roth, he could just log in and make the contributions to his Roth. But since he got a UTMA with their firm, soon as his name come in, it links all his accounts together. His name and social security number, it link everything together. And it said, oh, this is a UTMA account. You're not 21. You can't contribute to it. Right. So he used to come in and log in with my login, and he got like a certain percentage from his paycheck throughout the month, how much he was putting in there. But that little joker been slacking for like the last few months. I say, it's been a long time since you came and logged in. I know I've been slacking, I know. But his girlfriend had a good Christmas, had a good birthday. They be eating sushi, going out on dates. He love to go to the little Oriental restaurants and be eating. Every time we sit down, you got a sushi menu? Yeah, can I get a sushi menu? Hey man, we've been on here for a long time, but hopefully this was helpful.
It was, Tim. Thank you.
Gang. Anytime y'all want to talk about stuff, man, just dealing with like trading and investing, and not just strictly about price action, like different types of strategies and stuff. If I got experience in it, we could talk about it. Just like I said, everything I talked about today, this is the exact thing that Lil Timmy Rogers did with my own personal portfolio. Right. I only speak from experience. I don't give you no hypotheticals. Now I might say if you do this, but the process that I'm going through, this is the exact same stuff that I did. This is how I entered. This is how I did. And I don't know if y'all remember, but back in the day, Mark was talking about something called a box theory or whatever. Right, where he was talking about buying different expirations at different times. You know what I'm saying?
That was that king, queen, pawn thing.
Yeah, something like that. But that was very similar to what I did. And I was like, okay, I took bits and pieces of that to like kind of tweak what I was already doing. And when I say tweak what I was doing, because before, like when I was, like, just say I was buying another position when we got that pullback, I may have been either buying like another contract of that same strike or a different strike, but for the same amount of time. So what I took from that was buying a different strike with a different amount of time. You know what I'm saying? Because I learned the value of leveraging the time. Because when you leverage the time, you can put less capital to work for more gains. Because if you buy it at the right time and it starts to go, options go straight up. Just like if you buy a daily expiration, you can make $20,000 in one day if you buy a big enough XPX position. I know this because I've done it, right? I've done it. I bought a $5,000 XPX call, right? And then sold it for 25,000, right? And it was for the same day. But because it went straight up, it grew exponentially faster than a call that I would have bought for 2 weeks later, because it was in the money, and every dollar that it went up, it's going up a real dollar because it's in the money already. And at the end of that day, the theta got to be zero. So as it's growing in the money is growing exponentially faster than the ones that are further out. You see what I'm saying? Because the ones that's further out, you're paying more money for it. So even though it's in the money, you're not recouping, you're not growing your money that fast because you've paid so much for the time that it's taking you longer to break even. And that's one thing that we got. I'm gonna say this last thing and I'm gonna go for real. Right? When it comes to options, right? We got to remember that we have a break-even point, right? A BEP, right? We got a break-even point, right? So if you buy a 12-month leap, right? I ain't doing all this writing with that. Type it to, right? If you buy a 12-month leap, right? Right. And let's just say let's just say you're paying over here. Let's go back. Let's go to we've been looking at the Qs all day, so let's go back to the Qs. We've been looking at the Qs all day, so we're going back to the Qs.
Thank you, because that's what I trade.
Right. So that is 614 right now. All-time high is 637. All right. 600. All right. So, right. So we're looking at a we're just gonna say 614 call. Right. Looking at a 614 call. Okay. So if let's go get real numbers. We're going to get real numbers. We're not going to pretend. Right. So QQQ. Right. Option prices. Right. And then we're going to go to come here. Expirations. We said 12 month. So we're going to look at a January 2027. So January 2027, and we're looking at 615 on the call. They don't have a 14, so we're looking at 615 on the call. That's our at the money, right? And we're just gonna look at the mid price. All right, this is the last price, but we're just looking at the mid price. You know what I'm saying? Because that's when you do that's the in between of the bid and the call. So we're just looking at, and so we're just gonna say 64, right? So we're looking at $64 for a 12-month leap, right? So you're looking at $64 for a 12-month call, right? Equals $64, right? For a 12-month call. That's just right now, right? That's right. Did I do that right? Yeah, $64. Okay, for a 12-month call. Now, if we look at January, February, March, April, May, June. So June, we're gonna look at the monthly expiration in June. So that'll be June 20th, right? That's the third Friday. When I used to buy my like far out what's names, unless I was buying it like 2 weeks out, I always went to the monthly expiration. Sometimes you could go like in them little weeklies and find like a deal sometimes, but most time I ain't worried about that. I just looked at the monthly expirations, but do your own research. All right, so 615 615 call right here is, we'll round up and say 24. Right, we'll round up and say 2,400. We rounding up there. We round up. Did we round up last time? What did we do? I can't remember. Okay, so that's 6 months. All right. And then and then did I say 2,400? Yeah, 2,400 for a 6-month call. And that is June, right? Yes, June. All right. So we got 2,400 for a set, and we're doing at the money, right? We're doing at the money for a 6-month call. So now when you paying you're paying $24 for that. So six 14 plus 24 equals 638, right? So at the end of 6 months, right? At the end of 6 months, price needs to be at 638. See, 6-month break-even point, right? At the end of 6 months, right? Price need to be there for you to, that's your break-even point. So at the end of 6 months, if price is anything less than 638, you're not break even on this trade. And that's at the end of 6 months, because you paid $24 for the contract, right? So 614 plus 24 is 638, right? So you need it to be higher than 638 at the end of the 6 months in order for you to break at least 638 for you to break even on the trade, right? And then for the 12-month, right, we said it was 64, 614 plus 64. You need to be at least 678, right? 678. Right? That's way up there, right? You need to be at least there at the end of 12 months. If you hold it for that long, that's your break-even point. If you hold it all the way to the end of expiration, right? So if you hold it all the way to the end of expiration, that's your break-even point. That's where price needs to be when that contract expires, if you hold it in, that contract needs to be there in order to break even. So let me see here. So that's, let me see, you paid 24. Y'all working my brain right now. So we paid $24, right? And it's at, oh, you're buying it at the money right now. So you're paying $24 for it at 614. You're buying at the money. So you're paying $24 for the time, right? You're paying $24 for the time, because right now at 614, the intrinsic value is zero. It's worth nothing, right? It's worth nothing because you're buying 614 at 614. I think it was 615, whatever it was. But we, you know what I'm saying? Y'all get the picture. It was like 615. I think we looked at 615 strike. We did. Right? 615. 615. Okay. So, right. It's at, so right now it's at 614.31. Right. So 615 minus 614.31. Right. That's 69 cents of intrinsic value. And you paid $24, right? Plus 24. Right. So you paid $23.31 for the time, right? With the 6-month call. So over here you paid $23, right? So you paid 23.31. That's how much you paid for time on this one inside that contract there. So you paid $23.31 for time, and then 64 minus, what's that? 69 cents. 64 minus $63.31 for time up here. What did I say? 63.31. I thought it too. What down? Right. So here, right, for the leap, and it's just we using real numbers based off this right here, right? So buying a 615 call, right, based off the midpoint today, right? You would pay $23.31 for time, and you got 69 cents in intrinsic value for the was no, because it's you buying a 215, and so it's not there yet. So you got to add 69 cents to that. If you would have bought a 214, then you would have 31 cents. But since we ain't got a 214, you don't subtract the 69 cents. You got to add, it ain't got no value. So you're paying the whole 2,400 for time, right? Like I was saying before, right? So you're paying that whole 2,400 for time. All right, because you don't have no value right now. It's worthless. It's you bought 215, right, at 214, whatever. So it ain't, you're just paying for time because it don't have any value right now. So you paid the you ain't paid nothing for time. Now, if it was if it was let's just say if the price was 215.31 right now, then you would subtract that no 215.69. If the price was 215.69, then you would subtract that 69 cent and say you paid that for the time and this for the time, right? But since it's not in the money yet, right, you're just paying that amount for the time. Like I said the first time, right? So you're paying this amount for the time. All right. So now you need it to hit there for break even. If you hold it for 6 months, you need it to hit here for break even if you hold it for a year. Okay. Now we bought a 215. All right. And theta is real tricky, right? Theta real tricky. So we're going to do a fake calculation to just so that we can get some theta numbers. All right. So 2,400, we're going to divide it by 6 just to say theoretically they charging X amount per month for time, right? Because it's 6 months. So 2,400 divided by 6, $400 a month for time. That's what we're going to use for that. And then 6,400 divided by 1,200 divided by 12, $533 per month for time. All right. All right. So those are the fake numbers that we're using. They don't act like that. You know what I'm saying? But we're just using these fake numbers to get some calculations, right? So we'll say for a month and a half, right? In a month and a half, we move from here up to this high right here, right? From there to that high right there. All right. So at that high right there, that's 637, right? So from 614 to 637. All right. So we're going to say 637 minus 614, right? So now we are 615, I'm sorry. 637 minus 615. We are $22 in the money on both what's the names, right? We $22 in the money. All right. So as we moved up, right, we're $22 in the money. So that's 22, and then the time, well, and you know, as theta go along, it get less and less, and it changed and all that right there. But just for the strict, what's the name of saying, hey, it's what we said, 400, right? 400 a month. They was charging for 6 months. And what did I say? A month and a half. How did I say? How long I said? A month and a half.
Yeah.
I said a month and a half. Okay. So what's that? That's gonna be 400 a month. So times 1.5. All right. So that's 600. Let me see, a month and a half, 400 and 200. Right. All right. 400 and 200. All right.
700.
What? 400 plus 200 to 600.
No, you said a month and a half. A month is what? 400. Then a
Yeah,
half a month would be
200.
200. So that's 600. Okay. Oh, hush, Tim. Seeing if you were listener. That's all.
1800. All right. So and then that's the time. 1800. So plus 2200. Right. So 4,000. Right. So now, but theta don't work like that, but we just using this to get like quick numbers. Right. So when we hit that high right there, just using quick numbers and saying it took a month and a half to get there. We're just making this up. Right. So now, right, this right here is 4,000. And then there. $1,600. Right. You'll be up 1,600 there. Right. But theta don't work like that. So we're gonna see how this fake math work out. Because it's, it's exponential. It's like it'd be growing like differently. All right. So then times 800. Right. 6,400 minus 8. Six plus 2,200, 78, 78. Oh, 7,800. And 14. Right. So theta don't really work like that, but just based off some hip pocket math of just dividing a theta by how many months out, right? At the same high, same strike price, bought at the same time for different expirations, right? You got a larger gain on the shorter time because based off the Greeks and how they work, the money grows exponentially faster with the shorter time. That's why the shorter options are so attractive to traders, because you can grow the money faster when you buy, but you have to be surgically correct with your direction when you get in, the really daily and weekly options. You got to be surgical with your direction. But this right here is just a quick hip pocket way of seeing the difference in how much it changes based off the shorter times and the longer times, and seeing if we hit this price in a month and a half, you will be up $1,600. But if you're at that price at the end of 6 months, you're just break even based off the money you spent and what it's worth at the end of the expiration. And up here, if it's at this price, at the end of 12 months, you're actually in the red, right? If it's here, because this is your break-even price up here. And if it's at this price at the end of 12 months, right? When you got that one, you're actually $4,000 in the red, because you paid $6,400 and 78 to 38 is $40. So you'll be $4,000 in the red if it closed here at the end of 12 months. Right? So I don't know. Hopefully y'all got something out of that. That was fun. That was fun just to go through and look at options. This used to be my baby. Options was my thing. I was the options guy. When I learned about options, this is the first thing that changed my life. Options. And then futures. Like, man, why ain't nobody tell me about futures? I ain't got to worry about these Greeks. Hey, man, hopefully y'all enjoyed this. If you didn't, hey, at least I tried. Tomorrow is New Year's. The market is closed. Happy New Year, everybody. It's 9/17. Y'all could be anywhere in the world, but y'all here hanging out with me on New Year's Eve talking about stocks, options, futures, price action. Oh man, I had a ball. Hey, if ain't nobody got nothing else and all hearts and minds are clear, I'd like to thank y'all for tuning in to another episode of Tim Tidbits. Like I like to say, my name is Timothy Lee Rogers Sr., aka Aranya Grande. That just means big spot if you don't hablo español. Until the next time I decide to get on Algo's internet and share my thoughts on this thing. Why did you stop trading the option? Was it the Greeks? Yes, it was the Greeks. My name is Timothy Lee Rogers Sr., aka Aranya Grande. Until the next time I decide to get on Algo's internet and share my thoughts on this thing that we like to call price action. Y'all enjoy y'all New Year and be safe out here in these trading streets, man. Gone.